Yeah, so this paper was actually the paper that I wrote when I did ITC in 2016. How did you find it?
Where did I find it?
Yeah, how did you find the paper?
I went through the required first without checking the solution. Like, it was quite better. Just that finance is not my thing. So
Yeah.
when I went through, I was like, okay, A and B was a little bit fine. About C, yes, I didn't know what to do. For the whole 14 months, I was like, how am I going to get this 14 months? The calculation, I know, okay, I know what they're asking about, just that I didn't know if I was going to get the amounts. But I know how to calculate these things that they're asking about here.
Yeah, because for this session, I actually wanted to cover C, part C and part E. So actually the discussion question. Yeah, just cover that quickly, and then yeah, after that, then we can just cover anything else. So I'm sure you have it in front of you, but I'm just gonna put it on the screen as well.
Okay.
So let me know if you can see it. All right, but then, so part C, they're basically saying, so they're asking us to identify the monthly variances that Mr. Umaki could calculate to provide useful feedback on each vehicle and on each driver's performance. Explain the usefulness to Mr. Umaki and all the drivers for each variance. So even though they've discussed variance analysis, when you're going through variance, you want to think about, of course, standard costing, and I like to use that as kind of like when it comes to variances, like, what are the sort of variances that we cover in standard costing, and then when you usually have to discuss standard costing, discuss and use that as inspiration on how to come up with variances. So that's one, standard costings, and that's mainly obviously going to be from a costing perspective, but then also from a revenue perspective, we know that in standard costing we also discuss like sales and mix variances, price variance, volume variances, and all that kind of stuff. So also use that, from a standard costing, but then also from a revenue perspective. But you can also see that for this section, if you do your profitability calculations, those would have also come in very, very handy, very useful in this sort of scenario. Now, what's important is you of course have to understand what's happening in the scenario. So I thought, right now at the moment, using an Uber, using Taxify, all that kind of stuff is probably quite useful, quite familiar, and then maybe you have a sort of idea around the business model that they go through. But when we did it, it wasn't that new, but it was still new from a business perspective, because we maybe would use it going to and from varsity at that time, but we maybe never really thought of it from a business perspective. How is it going to help? How does it work? Do you look at kilometers? Don't you look at kilometers, and things like that? So you can expect that to happen in any of your exams, but what you want to at least try and think about it. Most of the times it's something that you would have used before, or something that is similar to something that you would have used before. And then that's also the other part of being a chartered accountant, is you'll be able to move into different industries just because of your core competence and your core knowledge base. Right. So I think what I want to cover in going through the solution is, of course, we're going to look at the solution, but we want to work backwards and think, okay, why is this important? And then how can you, I guess, transfer this knowledge to, if you had another industry such as the airline, such as a shopping market, such as I don't know, exotic or luxury car industry, if that makes sense.
Yeah, I think the problem was that it's not that I don't understand the required, but in this case, we are given a different industry. I've never been exposed to a service industry where we are doing those variant things. So now we are used to what material variance. Now I'm going to ask myself, how am I going to calculate material in the service industry? So that's the whole thing that knocked me out in this question.
Yeah, and that's the sort of thing, right? Like, it's gonna always be a different industry. Like you can expect things, and with the businesses that are evolving now, there's Instagram, there's people that are making money on Instagram, people that are making money on Twitter, people that are selling cars. Some people don't sell cars, some people sell clothes. There's different things that happen at all times. So you kind of you expect that the industry is going to be completely different, but you want and that's basically what they're trying to test in test of competence, is that you can transfer your knowledge and make it work for each industry that you're going through, right? So like if you start off right, off the beginning, like if you look at the first one, right, monthly kilometers traveled versus budget, monthly productive kilometers versus total kilometers, revenue versus budget per vehicle, revenue generated by each driver, average fare per trip, numbers of trips per operational hour, right? So if you just start there, anything that you operate with, you want to compare. So especially when you're doing variance analysis and you're discussing it, anything that you're operating with, you want to compare to budget. You want to compare to what is, when you're doing variances, of course, you need to have like you need to compare something to something. And then an easy one is always going to be budget. So if they've given you a budget, and most, like in this scenario, they have the individual, Mr. Maki, had an idea of how much they expected that they were going to spend per year, how much per annum, how much hours they're going to use, how much petrol they're going to use, all that kind of stuff. That's, of course, before you operating, that's going to be your budget. So you're most likely going to always compare something to budget. And if there isn't a budget, say, for example, and in most scenarios, you'll compare to budget because they would have had to thought about something before. But then you also might be able to, if you don't have a budget, you can think maybe like your industry average or your previous year, for example. Does that make sense?
Yes.
Right. And then, so because you're comparing to budget, it's just really just and then that's the first thing you need to think about, okay, budget or what you're comparing it against. And then the second thing is what, I guess, drivers, like when you're thinking of activity-based costing, what drivers drive your business, right? So in this scenario, of course, your kilometers significantly impact the cost that you're going to incur, because the more kilometers you drive, it means service is going to be sooner, it means petrol is going to be finished faster, and it means your tires, for example, are going to be are going to need to be replaced sooner, right? Now, this is kilometers, but in another industry, if you are airline, it's also petrol, but if you, for example, in I don't know, let's say you are companies that publish books, right? So companies that publish books, big costs that they might incur, of course, is the paper, all that material that they might need, and then also the editors' fees. So if they're hiring a team of editors, how long are the editors taking to basically come up with the same result that they were coming up before? Do you get what I'm saying? And then there'll be a budgeted time. So if you're an editorial company, maybe they'll tell you that it's going to take us 60 hours before we review this book. You want to compare, did they take 60 hours or did they take 40 hours? And if they took 40 hours, which is faster than 60 hours, did they do that because the book wasn't finished, or did they do that because, this person is actually working a lot better? Make sense?
Yes.
So like they said, monthly kilometers, and then they were explaining, so provide information on total kilometers traveled and useful for determining the cost per kilometer. And then the variance also provides valuable information regarding customer trends in terms of average length of the trip, can be used strategically in terms of increasing fleet size at some stage in the future. Now, what's cool about this solution is that this solution would have asked, you know, us as students to come up with these responses. But what I think is also would be useful for you now that you're going through it, you could almost keep the solution and use this as a template and, you know, almost like a study cheat sheet to explain to you why variances are useful in the event that they will probably not ask you this in this much detail, but knowing why these variances are useful could help you the next time you do an exam and you need to calculate the variance as opposed to explaining the variance, because now you have kind of like an explanation of why comparing monthly kilometers traveled versus budget, because this is going to help determine cost per kilometer. So now we could see we calculated the budgeted kilometers was X, and now we actually see that the monthly kilometers was Y. We will see that was our budget accurate? Was our budget too high, or was our budget too low? Now we can update it. And then on top of that, that's just from a cost perspective, but they've even mentioned from a strategic perspective, we can see that customers are driving longer or customers are driving shorter. So if customers are driving longer, then we know that, okay, we need to always have more petrol. We need to target more customers in certain areas, but you know, and then we also know that we're going to make more money on longer trips. But if customers are driving shorter, we definitely want to be in the areas where it's most profitable for us. Customers driving shorter means less petrol, but then we're going to need a lot more customers each trip just to make a certain amount of money. Right. Now, again, so this is monthly kilometers for this industry, but think about how you would apply it to if you were selling shoes, you were selling clothes, you were selling sweets, you were selling bread, you were you're a lecturer, or you're in the business of tutoring, or you're in the business of coming up with study guides, you're in the business of, you know, being an influencer and you make your money off YouTube, you in advertisement, or you in modeling. You know, I guess what sort of metrics would you use that fits this sort of like explanation? Okay. The second one, they said monthly productive kilometers versus total kilometers. And then they said the kilometers traveled on a fare paying trips versus total kilometers traveled provides the useful information on productive use of vehicles. Yeah, so this is quite important. So imagine you've got a driver that's that lives in Johannesburg, and then they operate in Pretoria, right? So for the day, they're going to travel from Johannesburg to Pretoria. Then, while they're in Pretoria, they're going to travel and pick up students, or they're going to pick up businessmen, business ladies, people going to the shops, to the doctors, whatever, up and down. And then once they're done, then sometimes while they're waiting, they might be driving around, going to get food, or they might drive to another location because they think it's going to be useful. And then when they finish, then they have to drive all the way back to Soweto. So now we know that in a day, we're going to drive a certain amount of kilometers. But of those kilometers that we are driving, which is also basically adding more kilometers on the car, adding petrol that we're using, of those kilometers that we're using, not all of it is actually generating money, right?
Not all of it is generating money, huh?
Because remember, if you're driving from Soweto to Pretoria, you're not generating any money with those kilometers. Only once you're in Pretoria, you pick up someone and you drop them at their location, that's when you're generating money. So you want to separate the total kilometers driven in a day versus the kilometers that are actually generating you money. Because as a driver, if your money is based on kilometers, you want to make sure you're using more kilometers that makes you money, as opposed to kilometers that are getting you to and from your home to where you want to operate. Does that make sense?
Yes, it does.
Right. So that way, Oh, hi there, Minnie. Sorry, I didn't see you jump in there. How's it going?
Hi. I'm good, and you?
Good, good. Yeah, we got Tulongeni here. She's from UJ. And Minnie, you from, is it UKZN, right?
Yes, that's right.
Oh, perfect. Yeah. So, and then I don't know if you've seen the banner, but I am recording these sessions. I hope you don't mind. I'm just using it so that we can, I guess you guys can refer back to it in future if you'd like to.
Yeah, that's perfect.
Awesome. Cool. So then, yeah, just a quick summary. We're just focusing on C. We will focus on C and E, which are the discussion questions for this ITC paper. This ITC paper was actually my January paper when I wrote it in 2016.
All right.
Cool. So yeah. So going back to the productive kilometers. Now, because this is a company, this is a Uber service company, right? Kilometers are the biggest driver of their revenue, but it's also the biggest driver of their costs. Now, we know that a driver, wherever they live and wherever they're operating, there will be kilometers driven there. And there'll be some times where they're just driving around, going to get petrol, going to get food, maybe going to get medicine or going to a better location if they've heard something. And essentially, we would want to track to see, okay, in the total amount of kilometers that we're driving, this car is driving every single day, how many of those kilometers are actually productive in terms of making money? Right, because if we know that there's a lot more kilometers driven that's not making us money, then this driver, for example, might be, quite wasteful or not efficient, or just maybe the area that they're operating in is not useful at all. So that's where that kind of like productive capacity comes in useful. Now, this is for Uber company. If you were for example, like auditors spend a lot of time, charging out their money. So they track every single day their trainees or their employees, and they want to basically account for what they're doing every single hour, because if you're supposed to be working for 8 hours, that's 8 hours that you would charge your client. Now, if you're going to work less than those hours because you may be on social media or you're just going up and down for coffee, then you're obviously not actually being very productive, and then that might cause some issues. So you track that to make sure that one, employees are not wasteful, but if it's not an employee's fault, what are the sort of activities that is happening in the business that could maybe be removed to get into a position where you're making more money per hour that you're working. Now that's per hour, that's per kilometer. If you're selling clothes, if you have material, you want to make sure that of the total material that you're making, how much of that material would you actually convert into clothes that you can actually sell, because you don't want to be wasting it. So I guess you could say this sort of variance could be very useful to looking at wastage. Cool. And then, yeah, any questions there? If you got any questions, just let me know, or you can type it up in the message box and I'll look at it. So the next one is revenue generated by each driver versus your budget. Again, so with most industries, you'll compare something to your budget, your industry average of the year before, and then it would be very useful. In this case, it's revenue, but it could be petrol used per driver, it could be salary per driver, it could be kilometers per driver, it could be number of accidents per driver. And this is quite useful because then not that it's always great, but then you can compare your drivers, so you can see which driver is performing better than the other. You can see which one is being most efficient, which one is not being efficient, which one might need a promotion, which one might need a raise, which one might maybe need to be removed, or which one might actually need to work a little bit harder when doing the activities, because I'm sure, as you know, like your employees or your salesmen or whatever, you want to make sure that they're most efficient. And if there's anything that you can help to help them become more efficient, the only way that you can know that is if you monitoring variances or calculating certain metrics. Okay, cool. Average fare per trip versus actual versus budget. This would be useful to monitor average fare. The higher the fare per trip, the greater the profitability. So this would be similar like your price variance when you're doing standard costing and you're looking at your sales side, because you would hope that you would either increase your pricing year on year and not lose customers, or if you're going to keep your pricing the same, get more and more customers every single time. So your average fare per usage. So now in this case, it's fare per usage. If you were selling, apples, it would be the price of apples, so on and so forth. So, I would encourage you guys to get into the habit to continue to try and whatever you learn in one scenario, try and transfer it into another scenario. Of course, they're not going to ask you, okay, come up with variances that would be useful, but what they might ask you is to calculate variances or explain the variances. And if you see variances that they've already given to you that are very similar to the variances that we've gone through right now, you can actually see how useful they are, and then, use that to your advantage in terms of explanation, or use that to your advantage in terms of how to calculate what will be useful, what won't be useful. Cool number per trips per operational hour. So what's interesting is that you could, the same way we were looking at productive kilometers, another factor that's important for this business is the hours that they're operating. There's only a certain amount of hours, and any hours lost is effectively money lost. And you would expect, or it would make sense that you would want to get more trips per hour, because that will increase your revenue. So in this case, like they explained, it provides an indication of productivity of the vehicle's drivers. From a strategic perspective, would indicate the uptake in the market of Ubex and Mr. Marquee service, as well as the customers' preferences. For example, if you see, this would be very useful to see, or to show that, between 7 o'clock in the morning to 9 o'clock, 7 o'clock in the morning to 9:30, that same morning, that's when we're really, really busy, right? And then you ask yourself, okay, that's probably because that's when people are going to work, people are going to school. Then you could even do that. Okay, 7 o'clock in the morning in Joburg compared to 7 o'clock in Pretoria is actually very different. In Pretoria, I don't know if it's true, but in Pretoria, the times might not be 7 to 9, it might actually just be 8 to 10. Right, so that you know that there's different hours that are more productive. Now, where you're going to have your most productive hours, that's obviously the hours where you want to be working, and where it's actually slow, you either want to not be using too much cost. So like, between 11 and 12, everyone's at work, everyone's at school, no one's really driving around. If people are driving around, it's interesting to know where they're driving. Why are people specifically driving so much between 11 and 2? And you want to be there so that you can increase your revenue. And then again, between like 4 o'clock and 7 o'clock in the evening, that's when people are going home. That's again where you want to be operating. And then you also want to be operating in like areas where a lot of people are using Uber. So you don't want to go to an area where people are driving from home, going from office to home. But if most people in that area use public transport, or if they use cars, it's not going to be useful for you. But you can see how, in terms of from a customer preference, which times do they usually use it? Like weekends, Fridays, after 8 o'clock, that's when people are going out, going to the club. Sundays, maybe coming back, going out for breakfast, but they might still be drinking, so they're not going to drive, so they'll go back. And then you'll look at which areas, especially like student areas for you guys, close to UJ. I'm sure at certain hours or certain times you can expect more Uber drivers around there, because they're tracking these sort of things from experience. And then if you have it on a piece of paper, you can actually make like strategic planning, saying that, okay, all my drivers must be on this date, they must be at this place at this time, because we're expecting these customers to be in and around. Make sense?
Yes.
Perfect.
Yes, it does.
So that's productive hours. Fuel costs per kilometer, that's quite straightforward. What are your costs breaking even against revenue? your fuel variance. Let's look at this one, further broken down into a cost or a usage variance. This will aid with identifying where the fuel costs are not being in line with budget is due to changes in fuel price, which are uncontrollable, or using more fuel per kilometer. So this is specific like standard costing. So if you budgeted an X amount because you expected that you were going to drive certain kilometers in this year, and then you can calculate your liters per kilometer, then this way, this will help you see that, okay, what I budgeted was accurate, but now if fuel price went up and that's why I'm spending more, okay, I can't blame my drivers, I can't blame anyone because that's not their fault. But if fuel costs are going up because or the amount that I'm spending on fuel costs is going up because my drivers are driving to taking longer, they're driving to other places, they're driving to places that we didn't agree upon, then that's something that we need to monitor. Or there actually might be a problem with the car and it's just like leaking, fuel. So by doing these analysis, it's very, you can see how useful it is. Cool. So then they've discussed fixed cost, of course. Profit share per driver versus budget, provides drivers details on a net take home, and allows them to identify star performers and underperformers. But kind of spoken about that. And then unexpected cost variances by drivers, for example, traffic fines, tire bursts, windscreen cracks, excess on insurance claim. So unexpected costs, that would be quite interesting because that would of course not be included in your budget. Then if it wasn't included in your budget the first year, it might indicate that the next year we need to include it into our budget. And then it also helps, with monitoring, who are getting too many checkery fans, who's not driving quite nicely, windscreen, how many times have you cracked your windscreen, why are you driving that way? Right. And the driver ratings versus average ratings. This is basically one way to, it's a one metric to measure how well a driver is doing. And then if you were say a manager or a boss or a CEO, using a metric to manage how well employees are doing is quite useful, because then you can actually see, like when we discussed about star performers and underperformers, you could actually use this metric to I guess evaluate them. Right. Now, again, I want to emphasize that, chances of you getting a certain question like this again, this year or even in ITC is not very high. But what I want to say is that, this is very useful because for me, I'm looking at this as a cheat sheet of variances that I can think about the next time I do a variance analysis question on another business, or the next time I need to come up with calculations that are variance, calculations on variances. I could use these variances and then adjust them for the industry that I'm working on. Okay, cool. So yeah, that was part C. I don't know if anyone, if we got any questions there.
It's just one thing I've realized that.
Yeah.
Who is going first?
Sorry, come again?
Hello?
Yeah. Are you saying something that you realized?
Yeah, I was saying something I've realized about students is that we don't want to calculate something new. We don't want to try something new. So when I was going through this question as for me, I was like, okay, this is what they're asking about. I know my types of variance. So I was asking myself that how am I going to get this 14 marks? Because we don't have much variance. I was going to list my variance that I'm used to. And then if this type of business don't have material variance, I was just going to left that thing out. And then I was going to calculate my revenue, price, and all other things, fixed costs. But I was not going to think outside the box that this is the type of business that I'm dealing with, because I'm just used to what we do.
Yeah, and exactly that, right? Like, I think what sometimes happens is that our lecturers or our tutors are always telling us apply, 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 and then they give us tutorials to apply the knowledge. But then we quickly get, as a student, you quickly get into the, I've done it, this tutorial went this way, so the next time I do this tutorial, you know, I'm expecting it to go that way. And sometimes it happens, it really does, but most times it won't, because that's not how a lecturer or your tutor is going to test if you really understand. The best way to test if you really understand is, we've given you one principle, we've given you one exercise to test that principle, but from what you've learned in that exercise, you know, you need to apply to the next exercise, but in a different manner, which is, you know, why I'm saying exactly that. Like you do want to use your standard costing variances and your performance variances that you've got in your lectures as a base. Of course, that's a base, right? But you can't really fit and force them into your scenario. Use them as a base, as a template. So you tell yourself, okay, when I do variance analysis, I need to look at costs. What are their costs? I'm going to do some sort of commentary on each of their costs, because I look at cost variances. Then I need to look at efficiency. So what you know, break even, you know, asset turnover, how well are they doing it? These are my categories, but now based on the industry that I'm working on, efficiency looks completely different per industry. So if you're making t-shirts, you want to use as less material as possible and still get a lot of money. You want to pay, your employees to work as little hours as possible, but still make a lot of t-shirts. But if you're an Uber driver, you want to make as many trips in the same amount of time, right? Which is like the t-shirts, but just now it's trips. And you use them as a base, of course, but you know, that's why sometimes you're actually saying exactly what the solution is saying, but then you're not stating kilometers. You're just saying fixed costs must be looked at, but you're not stating things like the fixed costs, which are your interest, which are your services, which is your insurance. You're not stating what is it, you know, specific to the scenario. And then specifically with discussion questions, one thing that always encourages me from an ITC perspective, there's 26 available marks. There's a maximum of 14. This 1 mark I need to get. How do I get that 1 mark? Is just making sure I'm writing neat, I'm laying it out, you know, using bullet points or using 1, 2, 3, 4, 5, things like that. Doesn't look all over the place. So I always get that. Then there's 26 available marks, right? For me to pass this question, I just need to get 7 out of 14. That's 50% for the maximum available. But 7 out of 26 is even less than 50%. So that's encouraging. Of the total available possible right questions, I don't need to get even half of the available ones. I just need to get half of what they're asking me for. And what I try to always do is, if it's 14 marks, it's a discussion question, I try to make sure I'm writing 14 to like 20 lines, because I work on the notion that, you know, of everything that I write, about 40 to 50% of it is going to be correct. So if I'm only going to write 7 out of 14, then that means I need to get all 7, which is 100% for what I wrote, just to pass the question. But if I write 15 or 20 out of the 14 maximum marks, then if I get 10 out of what I wrote, which is the 50% that I'm working on, then I'll get 10 out of 14. Of course, I've written 20. I only got 10 of that right, which means I got 10 of what I wrote down wrong. But that's fine with me, because the maximum that they were looking for was 14. So I actually have smashed the question if I write more lines, which increases my chances of passing. I don't know if that makes sense on your side, guys.
It does. And a good exam technique.
Yeah, exactly. Exam technique, especially when it's writing, it's always write more than the allocation. This is specifically, you know, for math. This is specifically for auditing when they're asking substantive procedures, things like that. Even from a tax perspective, you know, often if it's 18 marks, they want 18 lines of information. With tax, though, there is calculation, so you know you always get 1 or 2 marks there. So it might not be the full 18 that you need to write, but it's also like one of those things where in your exam, you don't really know how much you should be writing. So because you don't know how much you should be writing, you don't know when to stop or you don't know when to finish. So I use the mark allocation as an indication to me of how many lines I'm writing. So if I can get close to, it's 14 marks. If I can get close to 14 lines of information, 15 lines, 20 lines, then I know that I'm doing well. Right. Cool. So the next one was
Yeah.
identifying. Sorry, the question
Sorry,
there?
I have a question. Yes,
Yeah.
I do. With this question, with this a discussion question, like how out of the box must you be? Like I know you must contain it within the scenario, but like how out of the box must you be? Because for me, when I see 26 marks, I think I have to just think of things that most students wouldn't think about. So like what must guide me? The scenario must guide me, right?
Mm-hmm. So yeah,
Oh,
so good question, right? So I wouldn't even think of it as being out of the box because that's what you. I don't think that's what you don't want to do because out of the box kind of thinking kind of sounds like okay, everything that I learned now I need to be exceptional, on in applying everything that I learned so that I can get all the marks. But that's not really where we at, right? Where we at is I've learned that these are useful variances for businesses. These are variances that businesses look at when they talk about costs. These are variances or ratio analysis or calculations that people do when they look at efficiency. This is variances that people do or calculations that people do when they're looking at profitability. This is variances that people do when they're looking at investments, right? So that's you kind of have like your toolkit. That's your toolkit. That's you don't want to be coming up with it. And I say coming up with in terms of thinking out of the box. You want to have that toolkit like right now. Like I'm saying, this example, use this as your toolkit as categories for when you're doing variance or performance evaluation. Use these as like a toolkit, right? So that's your toolkit. You want to take out industry specific words and you kind of want to make it generic and bare, if that makes sense. Then, right now, when it comes into your scenario, the only out of the box thinking you're
that
doing.
makes. Thank you.
Yeah, so the only out of the box thinking that you're doing in your scenario is the fact that when you started this toolkit, we were looking at an Uber business, but now my exam is asking me about an ice cream company or it's asking me about a paper manufacturer. So I use the same toolkit, the same structure, the same base, but now where I was saying kilometers, I'm going to say liters of milk because it's an ice cream company, or I'm going to say grams of paper because it's a paper manufacturer. Does that make sense?
Yes, that does make sense.
Cool, because then I think it leads perfectly, into this part E where they say identify and discuss the key business risks. So the business, right? So business risk, we know that you can ask this question about business risk for each industry, each company that you're covering: ice cream, paper, hair care, shoe care, anything, right? So what I would say then is, again, use this question and the numbers are your categories that the next time I get asked a business risk question or a question that sounds like it's asking me for business risk, I use these categories to answer it. So it's about it's about like 8 categories. And then of course the explanation that they're going to give is specific to the Uber company. But I know the next time I'm doing another industry, I use this category or I use this bucket or this heading, and then I apply what I know about that industry from the information that they've given, and I apply that to the scenario. Cool. So start off.
That makes sense.
Yeah, perfect. So if you start off with the first one, it says the business has not generated. So key business risk. The business does not generate sufficient revenue or profit to enable Mr. Maki to receive his fixed profit share due to, for example, right? So that's also another thing, right? They've also business risk. We've said that the business does not generate sufficient profit. Now, remember how I was saying that we need to basically make it general and use these categories for every industry. If you're answering the question and you only say this, that's very generic, right? So then if I'm your marker, I'm just saying, okay, you're on the right track, but you're not really giving me anything that I can use because I could have just Googled this and then this could have told me something, but I don't know how this is applicable to my business. And that's why it's important that you give examples or you use words like Uber's increasing fares, right? That's specific to the scenario that you're going through. And fares are a specific cost or a specific consideration for this scenario. So they don't make enough. He doesn't make enough revenue or profit because UberX, which would have been like in real life, and Uber would have been increasing their fares, which could not make the service, which could make the service uncompetitive. UberX could be reducing fares, and then to remain competitive without a resulting increase in the volume of trips in Mr. Maki's business. Okay. Revenue being lower than anticipated, so we budgeted a higher amount than actually what happened, and that just could be because our budget was really bad. Inaccurate cost calculations, right? So if we're thinking fuel, servicing, and tires is lower than we actually are spending for it, this could be because whoever the suppliers we are using are higher, or we just use more petrol than we budgeted for, so that's going to be issues. Or the prices could have increased. Now, again, this is like a standard costing question, and if they had asked us calculations, we would have thought about, fuel price increasing, or fuel using more fuel, or the price of fuel increasing. But look, we've used standard costing as our base and then converted it into risks. Instead of saying, instead of doing a calculation saying fuel usage has increased over the year, we reversing it and saying there's a risk that fuel consumption is increased or fuel prices are increased. This one is always a favorite, the weak South African economy resulting in customers using cheaper forms of transport. Now, if you just say the weak South African economy, you're not going to get the mark because it's going to say, well, what about the weak South African economy? What if a weaker South African economy does better for some businesses? They go further and say, well, if the economy is weak, it means people don't have a lot of money, so customers are going to use cheaper forms of transport. So they won't use Uber, they might use public transport. The ability to attract and retain quality drivers with valid PDPs. Potential drivers may be put off due to the perceived security threats such as abuse from passengers, hijacking, etc. So in this scenario, the Mr. Maki had 10 cars, so he needed 10 drivers. If the drivers become scared, he's gonna have 10 cars, but maybe 9 drivers. If he even gets 10 drivers, what if he has drivers that are not very friendly, they're very dodgy, they don't drive safely? Not being friendly, you're not going to get customers, you're going to get poor ratings, so they're always going to decline them, or they're not even going to get allocated drives. If they drive poorly, more accidents, right? And if they don't think, too well, then they're not necessarily going to be in industries or areas where they can make more money, right? All of these are still building up to the main bucket of sufficient revenue. And you could have quality drivers in another industry, it's quality chefs, it's quality cooks, it's quality students, it's quality workers, it's quality thinkers. This could be replaced. Weak economy applies to any industry. Inaccurate cost, doesn't matter what industry you're driving with. Revenue being lower than anticipated, of course, you budgeted revenue and then something happens like Corona, you have less revenue. So these are these risks could have been changed for any industry. So you could even use this bucket, sufficient revenue profit as a risk, and then use these things in bold as your template of things you should say, and then just fill in the specific industry you're working. So increasing what? Price, increasing costs, reducing what? Revenue being lower, why? And they go further, increase competition, right? So other value sharing, other vehicle sharing services or other transportation services, Uber taking more drivers, so there's more people fighting in your area. There's other companies, Uber, there's a Bolt, there's Uber, Gautrain, meter taxis. Customer preferences from luxury to UberX, that could change. Taxi violence is obviously a big thing. Vehicles breakdowns, and then requires major expenditure, that reduces profit. High accident levels due to drivers trying to fit in as many trips as possible, so they're driving too fast, right? So we need to also push for higher revenue, but then also make sure that if they're pushing for too much revenue and they crash the car, you lose all the revenue you might get. And then drivers use vehicles for UberX trips. So that's obviously a big one. So you find a customer on Uber, then you approach them and you tell them, okay, well, you know, if you're always going to drive into work, just call me every single day and then I'll give you a nice discount and you don't have to put it on the app. Business model being reliant on continuous access to technology, should cellular networks or the availability of UberX app become impaired, customers will be unable to log trips required, right? So, you know, technology is always one, I guess, you can throw in, but it's never really like, you know, the focus of the scenario. So that was number one, basically not making enough revenue or profits. Number two, they've said Mr. Umaki sees a fixed share. He has no upside benefit, but all the downside risks. So he will still have to fund all the full costs of the vehicles if the business is not profitable. So this one wouldn't really be very easy to transfer to all other industries or all other businesses. But what you could consider is, you know, in terms of value creation and shareholders, especially if you're the type of investor, you're the type of shareholder that's always footing most of the bill, right? And then there's just someone that has to come in and do the work. The person that's doing the work, they're putting in their time and effort, but they don't necessarily feel the pressure of, I guess, investing the money and the risk of losing it. So that's also, you know, quite a big deal depending on whichever industry. There's always going to be some sort of investor, and that investor, even though they might not be working in there all the time, they obviously do have high risk because they're the ones investing the money. Okay, number three, given the remuneration model, drivers may not get a reasonable remuneration for their work, resulting in them becoming demotivated, undermining the business's profitability. So this is a remuneration model issue as a risk, right? But you could change this, and in any other business, if you don't have a good structure in terms of how you're paying your employees. So if you give them maybe a very low base salary and then they make more money if they have more commission and stuff like that. So cool, start the low base, but higher commissions on how much money you bring in. But if you make it very difficult for them to make that money, then they'll be very demotivated. But if you tell them, okay, base is low, but even if you bring in one customer, you get like 200 Rand extra. So it's easier for them to make more money. You get more motivated. So, you know, looking at your remuneration models or your cost structure or your, you know, performance management is quite important from an employee's perspective. You can see how that's a business risk. Now, it might not always be translated into all industries because in this scenario, the drivers remuneration model and basically the business as a whole is very, very much intertwined. So you can see why that is a massive business risk. Mr. Umaki, number 4, Mr. Umaki will be exposed should he not have sufficient public liability insurance to legal claims resulting from injuries sustained and the death of due to accidents involving his vehicles. Now you can understand why this is a big risk because, you know, the passengers are in the hands of the drivers, who are in the hands of the drivers, who are in the car that's been driven. So anything happened there's a very strong link to who owns the car and then, you know, being liable for what happened to the individual. This might not always be the case as a business risk for other industries, but you can think if you like in the healthcare industry, there's a higher risk that you create a product, a medicine or something, it doesn't work out well, and then you get sued and you lose all your money, you lose all your credentials. So number 5, non-compliance with legal requirements, for example, government, local authorities. Is Mr. Umaki's arrangement a labor broker arrangement resulting in compliance implications, labor legislation? You know, basically, what are the labor legislations? So what are the legal requirements? What are the governmental and, you know, local authority requirements for this business? Reputational risk, you know, if there are, you know, any unsavory incidents, this will impact on him, which will impact on his drivers, which means that you won't get future drivers on the app. You might even get removed from the app. You know, so like if you've been in Uber, you're speeding, you know, they aggressive, they're bribing, you know, drunk driving, all that kind of stuff. Well, chances are you're going to have a low rating, you're going to be taken off the road, and then you just can't make money anymore. And then the business is dependent on the Uber brand. So if something happens to the Uber brand, you know, in the United States, and it comes into South Africa, Mr. Umaki can't control this. So he's very dependent on that. So hopefully that gets managed properly. But you know, he can't control it, and he needs to think about that. And then liquidity and credit risk, the risk that Uber will default on payment or delay payments to Mr. Umaki, thus negatively affecting the ability of the business to meet obligations, as remittances from Uber are the only source of cash. So yeah, they are relying on Uber, this Ubex company, receiving the cash from the customers in their bank account, and then being in a financial position where they can pay the individuals, the Mr. Umaki. So if they stop paying Mr. Umaki, if they don't have the money to pay Mr. Umaki, then Mr. Umaki basically has done the service and not gonna get it, and he can't control that because he's agreed that the money go into their business account, and if they run into liquidity issues, that's a big massive risk for him as a business because he's never going to get his money back. And then higher use if the vehicles than expected, resulting in the residual value of the vehicles declining. That's a big thing. And then because it was in his whole investment plan that he's going to get the 51,000 back at the end of, I don't know the amount of years, I think 5 years, and a mismatch of funding period and asset life. So yeah, that's, you know, that's just a general like solvency sort of risk. So you don't want to finance your car for 2 years, but then, you know, basically the car could be used for 5 years, and sometimes, you know, you're only going to generate the most of your money in year 3. By then you would have already needed to pay back your loan, and it could run into very massive liquidity and solvency issues there. So that was the part E of the discussion. I really just wanted to focus on the discussion. Also, like usually with these business risks, you often can use like PESTLE, so you know, political risk, economical risk, social risk, technological risk, legal risk, and last E I think is environmental risk. So like they had legal risk. Yeah, where was it? Legal risk, that's the L. Economic risk is of course all the costs, you know, revenue, costs, things like that. Social risks, this would be things like reputational. Environmental risk, not too big of a thing. Economical risk you mentioned. Political risk, not too big of a thing. Technological risk they did mention slightly because it's, you know, of course, continuous access to technology. So if you use PESTLE, you could have come up with quite a few of these risks as well on their own. So as a summary for this, you know, you could use business risk. This is like a good template. You could add this to your PESTLE. You could see if PESTLE fits into this. And then the next time you get a business risk, either, you know, from math or even in auditing, you could use these sort of like triggers. Don't again try and shoehorn them and fit them into your scenario, because that could negatively impact your answering, because you'll write a lot, but if you're not applying it properly, you'll miss out on a lot of marks.
I have a question.
Sure.
What about theft? Is it included under the insurance liability? Is it covered by the insurance company? Theft of like the cars.
So if the car, definitely. If the car got stolen, the insurance company would, I guess, be in charge of taking care of the car, so getting it fixed or getting it replaced. But on that point, there's going to be a delay. If it takes the insurance 2 months to replace or fix the car, that's potentially, you know, months of lost revenue that Mr. Maki might not get back. And insurance doesn't cover for loss of revenue, of course. So yeah, that would have been a good risk, I think.
Okay, thank you.
So that's basically all I had planned for the first hour. So for the second hour, I thought, if you guys had any like specific questions, maybe on this topic or this question, or if there was maybe any other math question that you wanted to cover, then we could go through that.
As for me, I'm fine with. That's why I maximize.
Sorry, so I think you broke up there, Tulongeni. What you saying?
So I'm saying, as for me, theory, it's where I maximize most of the marks. So maybe just a question. When it comes to calculations, that's where that's where I struggle. So just a question of how do I make sure I get them easy marks when it comes to calculations? Because theory, I'm good. That's even the one that I start with.
Yes. Yeah, I think that's a good approach, specifically starting off with theory, because I think there's a lot of easy marks in theory, but then also a lot of students, I guess, like shy away from theory, because if you think about it, with the theory, there isn't really like a template or like A plus B equals C when it comes to your theory, because you kind of have to like think about it. But like we spoke about before with Minazintle, is that you can use a structure to come up with your theory. So for your calculation, if you find a theory, it's most likely because you have a structure in terms of how to answer your theory, which your calculation is a similar process. With all your calculation style questions, there's a formula that you are given, and you want to understand all the inputs. You want to understand like the inputs of the variables and the inputs of that formula. What that means is basically knowing that what makes up that formula, but even going a step further and thinking, this is how the calculation or how the formula is set up. What are examples of the inputs that this formula needs that I could expect in a question? Or if you even done a question, look at, what are the inputs that they've used in this question? How did it fit into this calculation? Then going forward, you can tell yourself, okay, whenever we do discounted cash flows, we need to get revenue numbers, because you can't do discounted cash flows without revenue. So you can almost reverse engineer and think, well, if I'm doing a discounted cash flows, I need revenue or EBITDA. EBITDA revenue is usually shown in the scenario like this. They either give me an income statement and they tell me how much it increases by, or they give me revenue for each of the 5 years. Now if that's how the input works, that's how I can expect questions in future to give me this information. Then the next thing is working capital. Working capital is usually made up of inventory, trade receivables, and trade creditors. So whenever I go into the next question and they're asking me working capital, or I see working capital, I see inventory, I see trade debtors, creditors, and I see them increasing by 2%, then I can expect that I will use it for discounted cash flow. So it's more about like you want to have a similar structure that you have for your theory, for your calculation, and they often are structured specifically with math, because there's a formula that they give you, and then that formula is made up of the inputs. So if you get used to the formula, then get used to the inputs that are needed for that formula, then think of examples that tie up to those inputs. Then you can think of examples or scenarios where inputs that look like this, that look like the inputs needed for this calculation would come up. So you'll be prepared. Whenever they talk about costs, you can expect relevant costing, you can expect CVP, you can expect capital budgeting, that sort of stuff.
All right. But the thing is, with finance, you never know what these people want. Like what happened in our April assessment? What happened in our April assessment is that they asked us the free cash flow question. So when I saw the question, I was okay. I did so many questions on this, so I'm gonna score them. Actually, those people are good at changing questions. I don't know if it's the way that it's not effective, or maybe I don't know where the problem. But even though I knew the method, I knew the formulas, used to go there, it was a different thing. I was not supposed to use the formulas that we normally use. So I don't know how I'm supposed to. I don't know where the problem is.
Right. So normally the problem is either because like the change, I shouldn't even call it the problem, but the change in the way that they've answered this question is, or the way that they expected the answer is, one, because in the scenario they've said something specific. So they'll say something like, I don't know, they don't have an appropriate, they won't be able to project the revenue, or they won't be able to project each line item in the discounted cash flows properly. So then that tells you can't use discounted cash flows and you need to use like a different method, like PE valuation or something. Or in the scenario, or in the required, sorry, the required will be presented in such a way that sounds similar to what you've done before, but there'll be a change. They'll say, you know, based on the information given to you, what else would you need on top of the free cash flow? So it's not really asking you do the free cash flow. It's asking you, you know, what might be missing, what might we need to correct, that kind of thing. So I guess I always stand by what I say is that when you're doing a question, you still start at your base, is that you know what they're asking you, or you know what they're expecting you to do, based on what questions you've seen before. But always be prepared, or look out for, there might be one sentence that will mean that I can't use the exact same template I've used before. So you should always look out for that, because remember, like we started in the beginning when we were talking about discussion, how do you know what to actually say? And you can't always use what you've worked for you before, because then it's not necessarily applying your knowledge. Applying your knowledge is knowing what you've done before and then understanding the inputs and the scenario this time and using that to impact your answering.
All right, thank you.
Oh, pleasure.
I have a question.
Sure.
Oh, it's not related to this work. It's something we did last week. I don't know, maybe it's just my understanding. It's the market value, wait. It's the market value exchange ratio with synergy and without synergy. What does that mean? What is synergy?
Okay. So, right. So you know how when we do mergers and acquisitions, yeah. So normally mergers and acquisitions, we normally focus on discounted cash flow. So you'll have company A will be acquiring company B, right? Company A will acquire so company A will do a valuation of company B, and then company B will be worth a certain value, let's say 100 million. Then company A now needs to take 100 million and pay company B to acquire those shares. When you do the discounted cash flow, that means that you are trying to calculate the value of this company, great, and then most often company A will pay for company B by cash that they have on hand, or they will they will get a loan. The bank gives them money, 100 million, and then they use that 100 million to go buy company B. Or company A maybe goes into the market, issues out shares, gets 100 million, uses the 100 million to go to, and then pays that to company B. There is, however, a fourth option where instead of company A, because they don't have the cash or they don't want to use the cash, right? Company A uses its own shares as cash to pay for company B. So what are you doing? You're basically swapping its own shares for company B shares, right? The whole point that company A wants to do is get company B's shares back from company B. Now, instead of using actual cash, they use their own shares as cash, right? Now, why they can use their own shares as cash is because their shares have actual value, right? So their shares could be 10 Rand, company B shares could be 5 Rand, right? Which means that if we imagine that company B had shares, which was 5 Rand, and company A had money, or company A had taken those shares, sold it into the market, and then gotten the money back, essentially one company A shares could be converted for 10 Rand, right? And then you could use that 10 Rand that you've sold it in the market and bought company B shares. You could buy 2 company B shares for every 10 Rand that you have. Now, instead of going through the whole process of taking company A shares, going to the market, selling it to the market, getting 10 Rand, you just go straight to company B, give them shares, 1 share, and then swap that for its company B shares, and then the holder of company B, the person in company B who now has company A shares, can decide to sell it or wait until it increases in value or not. Now, because you're going to swap 1 share for another share, we know that shares are not all equal. So company B shares, like in my example, company A shares cost 10 Rand, company B shares cost 5 Rand. That means company A shares is more valuable than company B shares. So if you wanted to swap 1 company A share, you would expect to get 2 company B shares, right? So now you get a ratio. Every 1 company A share is worth 2 company B shares. Every 1 company B shares is worth half a company A share. So that's the first. To answer your first question, you get your exchange ratios, right? Now, where synergies come in, right? So when companies negotiate, right? Of course, the company that has the most valuable shares will need to give up less of their own shares to get of the other company shares. So if company A, I repeat, is 10 Rand for 1 share, they will get 2 company B shares because their shares are more valuable. So then if you value company B at 100 million, then you would only necessarily need 100 million to get whatever amount of shares that you have, that you want from company B. Company A would basically need to give 10 million of their own shares at the value of 10 Rand to acquire all of company B's shares. Right, so that's your exchange ratio. But now where synergies come in is because when company A and company B come together, there's a reason why company A wants to acquire company B, because company A believes that company B is going to bring something more to the party. Right, so company A might be working in one industry, company B might be a competitor. So they acquire company B. Now company A owns more shares of the market. And by owning more shares of the market, yes, it's the same as saying I used to have 100 million revenue. Company B also had 50 million revenue. Together we will have 150 million revenues. But where synergies comes in is that when you mix the 2 parties together, the 2 parties will have extra benefit than just adding their 2 revenues. For example, if you merge the 2 companies together, both of them had head offices, both of them were paying head office costs. But now when they come together, you only need 1 head office. So one of the companies can sell their building and make extra profit or extra money. So that's a synergy. A synergy is basically a creation that happens because the 2 companies have come together. They won't get this value if they just transact with each other by buying the one building from the other. If you put the 2 companies together, there will be cost savings. The one company might be more knowledgeable about how to, I guess, get money from debtors than the other company. So now when you merge together, you transfer all that knowledge and you into the new group at no cost, really. So that's why they often say with mergers and acquisitions, 1 + 1 = 3, because you take one company, you merge it with another company, but then your synergies make up the extra 1 because there was something that was created that was more than what is on the books. So it's more than just taking assets plus equity plus liability of the 2 companies and mixing the 2 trial balances together. No, there's extra that will be created because of these synergies, because there will be cost savings, there will be relationships that are made. These relationships will increase the revenues by tenfold. It will increase the revenues faster than if you had to go to a consultant or pay someone to do it. Because you can do it in-house, you will basically create extra value at no additional cost, which is what what's that extra reason, what's that extra value that you want to get or create because you guys are merging. It's not just because you want to add revenues together. right? Are you following so far?
Yeah, I'm good. Would that be like the last option for like a company? Because like giving another company your shares, doesn't that like dilute your control in everything? Or like are those shares gonna be like redeemable, like compulsory redeemable? I don't know if I'm making
So
sense.
that's a very good question, right? So yes, if you're thinking of oh, okay, why would you want to give up your shares? Because you might give up control. So you definitely could give up control. But, right, the benefit of giving up your shares is because if your shares are worth a lot of money, so then you can give up less shares. So you can give up enough shares that won't really give up control, and you'll still do the job of buying $1 billion company or $100 million company. So it's not, sometimes it's not the last resort. Um, because if you are giving up your shares, you would most likely want to give up your shares from a position of strength. So you would want to be in a position where the company you want to acquire, their price per share is like R1, and your price per share is like 1,000 Rand. So if you give up one of your shares, you get 1,000 of their shares, but you really want their company. So then you won't give up a lot of control, right? Because you give up 1,000 shares. I mean, one share. You bought 1,000 of their shares, and then if this company, is worth like 100,000, you only need to give up 100 of your shares, and you give up 1,000 of your shares. 100 of your shares wouldn't even like move the control percentage from your perspective. So when you're coming from a position of strength, your share value is so much higher than theirs. That's when you would do the exchange. So that's why a company that wants to acquire another company would swap their shares. Company that's being acquired, most times you want cash because you can use that cash, you can take that cash and invest in another company, you can take that cash and pay off your loans. But why you would accept shares is because if you really believe in your own company, right, and you believe in the company that's going to acquire you, the company that's acquiring you, they will give you their shares, which is worth 1,000. But if you believe that this merger and acquisition is worth it, you will accept the shares because in a year or two's time, that 1,000 might be worth 10,000 because your company being brought into the group is going to create such massive or useful synergies to the whole group that it pumps up the group's share price even higher. So that's why the acquiring company would also accept the shares. The share swap.
Okay, I understand. Thank you.
Perfect. Right. And then just to go further in terms of the ratio, right? So remember I was explaining to you that the ratio is basically the acquiring companies divided by the company that's about to be the acquirer versus the acquiree. So that gives you the ratio. So that tells you how many of my acquirer shares do I need to give up to get the acquiree shares, right? So that's usually like a very basic ratio. Then once you create synergies, it changes the ratio because if you are more responsible for the synergies, your value of your shares are increased, right? Meaning that the other party needs to give up more of theirs to get the same number of your shares. So I'll repeat that. So if, like, in my example where we had the company A, maybe share price was 1,000 and company B's share price was 1, that means the ratio is 1,000 to 1. So if I want to get, sorry, one of company A's shares will give me 1,000 of company B's shares. So that's my ratio. Right? Now, if I say my synergies for the two companies together are like an extra let's say extra 100 Rand per share, and we are saying that company B, who's the acquirer, is more responsible for that because their whole business model is they are like a fintech, and then the fintech is going to really help company A's group. So once company B is incorporated into the group, 100 Rand per share in terms of synergy is going to basically appear from nowhere because company B has been acquired. And we're saying company B is the main reason for that share. So because company B is the main reason for that share, then all that synergies, I'm just going to write this out. Just let me know when you can see my screen. Can you guys see my screen?
No.
No.
Oh, you guys still can't see it?
Not yet.
I also can't see it yet.
I can't see it. Okay, cool. Doesn't look like this one's. Still nothing, eh?
Nope.
Okay, quick fix. Sound open. Right. Let me know if you can see my Excel.
Yeah, I can now.
Right. So I was saying that company A's share price, right? Share price is 1,000, and then company B's share price is 1. Right. So then your ratio will basically be 1 to 1,000. One to 1,000, right? So that means every time if company A comes with 1 share, they'll be able to get 1,000 of company B shares, right? So now, if we say that on their own, basically the share price or the value of company A is 1,000 Rand per share. The value of company B is 1 Rand per share. So whatever the number of shares in issue, you times it by the share price. That's basically the fair value of company A, the fair value of company B. But as a share price perspective, it's 1 to 1,000. Now, let's say once these two companies come together, right, effectively, you would add the two market values together to create the new market value, which would be basically A, B group, right? And then their share price would basically be 1,001, because you'll just add 1,000 plus 1 and you get 1,001. But synergies, so market value, right? But when you add in synergies, right, there's something extra because there's efficiencies. Either B is really good at something, A is really good at something, or A and B create something in the middle, and then they create something by that wasn't included here and wasn't included there. So now it becomes created after they merge. So that's synergies. So let's say that there's 100 from the synergies, 100 Rand per share is going to be added, right? So that means the new market value. That means the new market value for this company should be 1,101, right? But I'm saying who's responsible for all those synergies? Well, the person responsible for the new AB group will be the market value will be 1,101, but the group that's more responsible is actually company B. B is more responsible for the synergies, so we add that 100 to company B, right? So now company B has a new market value, 101. So now our ratio has to be basically how many shares of company A, which is 1000, divided by 100 now, 101, sorry, of company B, right? Does A have to give up? So if you do that calculation, the ratio gets adjusted. So take 1000 divided by 101, and you see now the new ratio has changed. It's changed. I should actually put this here. Now our ratio has changed to 1 to 9.9. So in the beginning, 1A share will give you 1000 B shares. Now, because we've added synergies, because we know we know that once A and B come together, 100 Rand per share worth of synergy is going to be created. All of it is responsible, or company B is the responsible party for these shares. That means that company B's share price will increase by those new synergies. So now we've negotiated, now we've moved from 1 to 1000 to 1 to 9.9. Does that make sense?
Excuse me.
Yeah.
What if they say you have to round it off, the 9.9? I don't know. Maybe I'm just.
Yeah. So you could round it off to like a 10. It's possible. Then it would be 1 to 10.
Okay. Oh, okay. That's fine.
For example, the synergy went to B, but the synergy could have also gone to A. So then that increases the value of A, which means that the ratio would change from 1 to 1000 to probably 1 to like 1100. So every one share will give you 1100 of B shares. Or it could be split 50-50. So 50 goes here, 50 goes here. Increasing by the same value might keep the ratio the same. If you make this 1050. So it's less than 1 to 1000, but it's 1 to 20. Yeah, so it's less than 1 to 1000 shares that you're giving up of B. But it's more shares than you're giving up if all of the synergies was going to B, because now it's being shared. Happy?
Yes, I am. Thank you.
Right, cool. Any other questions?
From my side, I'm fine.
Okay, perfect. Great. Self-management.
Excuse me?
Any other questions from your side?
No. For now, no more questions from me.
All right, perfect. Well, I don't have any other Anything else to discuss? So I don't know about you guys, but can maybe call it a day unless there's maybe something else that you understand. Or if you have any questions in other subjects, that will be also fine.
I just wanted to know, when are we having another session like this?
Yeah, so
like tomorrow or?
Yeah, so there's another one. So I'm having another one tomorrow at 2:30, but for financial reporting. So for the math ones, was you two guys that confirmed, and then tomorrow there's I think 4 guys that confirmed for financial reporting. But that one is also similar style of going through a past ITC question, and then after that discussing what. Yeah, just discussing any other further questions like you guys have brought up now, you know, just regarding exam technique and merger and acquisition and ratio analysis. So yeah, if you guys would like to join that one as well, that would be great. But that one also I think will be recorded.
What is financial reporting? Is it the overall of how to report financial statements, or is it financial accounting?
Yeah, basically just financial accounting. Yeah, sometimes it's called financial reporting, sometimes it's called financial accounting, depending on which university. But on that point, the question that we will be going through tomorrow is actually more like disclosure specific. So it's also my ITC day 1 question, and that question was actually interesting because what was discussed was they gave us a scenario, and then for 42 marks they wanted a discussion on what was missing, what was wrong with the disclosure of their company at that time. So I think that will so I chose that one because I thought it was I remember that one being quite interesting, and I thought, you know, might be useful to go through in a group session with the students, because, you know, you don't always get a lot of disclosure questions all at once.
Because as for me, I only have 1 session left, so can one still confirm maybe just for an hour, and then maybe on Monday I can ask for extra sessions to be added?
Yeah, sure, that's not a problem.
Okay. But I think when I'm going to ask for extra sessions, they are going to ask me like, how many sessions do you need? What? I don't know how we are going to go about this, like the number of times. Is it gonna be 2 hours every day, or how is it going to be?
So yeah, so it really is so I want to just make sure that you guys shouldn't feel pressure to do the group session, right? So for me, the incentive for me to do the group session, of course, is that you know, there's only so many hours in the day, and then quite often, sometimes we'll go through questions that other students are asking all at once. So I think the group sessions are useful for me is because I get to basically tutor to a wider audience and then answer the same question and say it maybe once. So it's more efficient for me. From you guys, it's really up to you if you want to do the group session, because, you know, it's your sessions. You can do it more privately if you'd like. So the benefits of the private sessions, of course, you're asking as many questions as you want in your hour. It's just your questions. It's tailored to how you've asked it, and I've answered it accordingly. But from a group perspective, you also do see, like, I'm sure you guys have now, like, just experienced, you know, the same question but from 2 different angles. What works for you, what doesn't work for you, what you were thinking of in terms of exam technique, or in terms of your question that you wanted to bring to the table today, what Zintle was thinking in terms of her question that she wanted to bring today. So that's the benefit from a group, but there's no obligation to use your sessions to do the group sessions. You could always keep your sessions as private. Now, from my perspective, what I'm looking to do is which is the group sessions obviously on the TutorMe app, but then I'm recording the sessions because what I have found, or what I've heard, is after doing more group sessions is that, you know, sometimes even though you've been in the group, you want to listen to it again and replay it. So I would like to record it and then I would like to, I guess, edit it as basically as possible, and then have it on a platform where or have it in a manner where if you want to look over it again, you can go through it. It will either be sent to you, or it will be platformed maybe on like a website or something where people can just review these sessions without necessarily attending it. Or if you couldn't make it, you can watch it. Or if you found that it's answering questions that you'd like to cover, and maybe a student is asking the question exactly how you would like to ask it, or we're going through a question that you would like to go through, like the questions that we did today. That's what was my thinking with the group sessions, and then in terms of the recording. And then again, that of course also could be made possible with just a private session, and if someone's open to being recorded, that's also perfect. That's also fine. But that's basically why I think I've implemented the group sessions now. It's more efficient. I think it's faster, and then it maybe encourages a bit more of that group learning that you might have been used to, back with tutorials at varsity. But there's no obligation to do it.
All right. But yeah, it is a good learning opportunities because of different weaknesses. So we are learning from each other.
Yeah, absolutely. Absolutely.
Can I also confirm for tomorrow, if that's possible?
Sure. Would you like to be added into that one?
Yeah, I'd like to be added, please. What time is it again?
It's 2:30. This one is 2:30, not 2:00. This one is 2:30. Sorry about that again. This one is 2:30 till 4:30.
Oh, that's fine.
Financial accounting, yeah.
All right,
So,
you can add me as
I
well.
would also like to be added.
wow, perfect. You were saying Tulongiri?
I'm saying you can also add me for now because I only
Sure.
have 1 hour left.
Sure, no problem.
Yeah.
Okay, cool. But because we're finishing this one early, you're more than welcome to stay maybe for the hour and a half, because I actually owe you 30 minutes.
All right. Thank you so much.
Perfect. Okay, cool, guys. Thanks so much for attending the group. If you'd like, maybe if you don't mind, maybe just send me a private message or WhatsApp and let me know like how you thought the session went and any adjustments you might want to see maybe tomorrow or in the future sessions. But yeah, I really appreciate you guys agreeing to meet together at the same time. I thought it was a good session. I'll listen to the recordings and let you guys know how good we all sound.
All right.
All right. Thank you. Thank you very much.
Cheers. Bye.
Bye-bye.
Bye.